Is it necessary to take risk in mutual funds? Come, let's find out through a detailed analysis in this video. Let's take an example. Suppose an investor needs 20 lakhs at the end of 10 years to achieve a particular goal. Let's look at the investment options available. If they want 6% returns with a risk-free investment, then they have to invest 12k rupees on a monthly basis. If they can take moderate risk to build a portfolio that can generate 9% returns, in that case, they have to invest 10.2k on a monthly basis. If the same investor is willing to take higher risk in building a portfolio, in that case he has to invest only 8.7k on a monthly basis. So what we can understand from this table is that if an investor is leaning more towards risk-free investment, then the returns will be on the lower side. So they need to invest more to generate higher returns. On the other hand, if the investor is willing to take risk, then they have to invest only a minimum amount. So when we are ready to take risk, we might need only a lesser amount, and by investing lesser amount, we can achieve our investment goals. The second most important thing to consider when taking risk in mutual fund is whether you have the time. The reason for that is, if you invest in equity mutual funds, you should invest for at least 7 years. Because only if you invest for 5 to 7 years, your investment will undergo a complete market cycle. You would be able to see all the up, down, crash and recovery. You should look to stay the entire course of the cycle to generate higher returns in the end. For example, if you are pulling out of your investments if there's a market crash, or if you are aiming to invest those funds that you require in 2 or 3 years, this is not the right approach. You should know whether you have the time to invest for the long term. Then only you should think about investing in this. The next important thing that you should consider is risk tolerance. You should ask yourself whether you will be able to invest regularly in a market downfall. You should also be aware about your ability to sustain those investments in that market phase. If you think you are afraid of facing a market fall and will have sleepless nights, then in that case, you should definitely avoid stock-based investments or equity mutual fund investments. You should look to improve your risk tolerance level. So there are two options in front of you. You can avoid risk and invest more, or if you are ready to take risk, then you can invest lesser amount and proceed to achieve your investment goals. Which option that you are going to choose is completely up to you. Mention which option that you are going to choose in the comment section, and I will meet you with another interesting video. Thank you. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.